I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, private equity, and real estate. Let's get straight into the burning issues in private markets. No faith in credit is turning into faith in perhaps opportunity as investors start poking around the trash bin, digging into the shale patch to see if it's time to catch a falling knife. And now private equity is girding for a global recession. Let's get into some of these burning issues. With me is Bloomberg Sonali Bosick, Kelsey Butler, and Allison McNeely. Sonali, let's start with you. Private equity has been saying they have been looking for a downturn, hoping that valuations will become more attractive. Now that we seem to be getting closer to it, where is the risk and where is the reward?
Listen, we still have record amounts of dry powder out there, so people do believe that maybe it's time to put it to work once valuations come down. But guess what? Just because markets are private doesn't mean that they're immune to the risks that the rest of the global financial system faces. So if the growth in the economy starts to slow, the portfolio companies will also start to feel those hits, especially in certain industries like energy, travel, and lodging.
And are we seeing any signs of either existing deals that have gotten done having stress or potentially deals in the pipeline?
Well, listen, also, it's not even just the portfolio companies getting hurt, it's also the exits. The IPO window is not open right now, and M&A is also quite challenged. With that said, we have seen deals. And Steve Schwartzman, the CEO of Blackstone, has said it is the time to buy. But really, we have other people that take a much more tempered approach to this and say we're not going to know until the dust settles.
So how do we even gauge the risk versus reward? I mean, are you looking at their share prices of some of the KKRs of the world and the Blackstones? Are you looking at just sort of what they're saying?
It's a great point because we didn't have their share prices to use last time around. You do have to look under the hood because it's not just private equity. A lot of these firms have big energy portfolios also. The energy industry is completely roiled right now. And so if those companies can't pay back their debt or there are other issues there, then the Blackstones and Apollos of the world will feel more pain.
And we're going to be speaking a lot about energy debt and this pain that we're seeing within the energy complex throughout the show. Kelsey, on a broader sense, though, there is a question of when firms are willing to step in. We've been hearing they have all of this dry capital, as Sonali was saying. So are you hearing about a lot of them stepping in, or are they waiting for some of this to subside?
So a lot of them are saying that they're ready to pounce. They haven't quite done it yet, but there's certain...
They're ready.
They're ready.
But they're not doing it.
They're not doing it yet just because the situations that we've seen at this moment aren't necessarily meeting their risk profiles, but that doesn't mean next week things can't change completely. They're sitting on billions of dollars of capital, and this is what private credit funds do best. Step in when no one else is lending and basically meet that need.
Although there's a question at what level, right? I mean, a lot of people are saying that this is a cash crunch for companies that are uniquely hurt by perhaps the economy slowing down, given the coronavirus concerns, immediate cash flow issues. Are they willing to pounce at a level that makes sense financially? In other words, how distressed do things have to get? I mean, what are you hearing from people in terms of how much further the sell-off needs to go?
So a lot of them are saying that we're very close to that tipping point where they will step in. Again, things just change from day to day. So it's very, what they may see as an opportunity yesterday, tomorrow might be completely different. But one thing I will say about the private credit funds is ultimately, even though they are seeing these opportunities, they are a little bit nervous as well because they are lenders to virus sensitive sectors like travel, like gaming, lodging. There's over $200 billion of private debt that is lent to those types of sectors, UBS says. So they may be feeling the pain as well.
Well, talking about pain, let's talk about energy. Allison, the biggest disruption recently has been in energy-related assets. It's been pretty rough. Can you give us a sense of just how tumultuous this picture has been?
It's been really rough. We saw a pretty remarkable reaction in the market yesterday. Crude oil fell more than 30%. And alongside that, we saw energy credits just really across the market plunge 10, 20, even 30 cents on the dollar. Practically the entire high-yield energy market is trading like it could default at any moment, that some of those companies could be filing for bankruptcy.
Allison, I was looking at the spread, the extra yield that investors demand to own energy junk bonds over benchmark rates. It surged by more than 3 percentage points yesterday. This is unheard of in the history of the index in terms of a one-day jump to more than 14 percentage points over benchmark rates. I'm wondering, from your perspective, it looks like a falling knife. Are there people you're talking to who are catching it?
Not yet. I think a lot of energy investors are still hiding under their desks, quite honestly, trying to figure out where things are going to ultimately land and where the dust might settle. That being said, we are seeing more relative calm in the markets today. WTI is hanging around in that sort of low $30 a barrel range, and we haven't seen as much movement in energy credits. So I think we're going to start to see investors maybe stick a toe back in, start to wade through some of the wreckage, and see where there might be some deals now that we've seen, relatively speaking, a bit of stabilization.
Some deals, some bankruptcies. Allison McNeely and all of our reporters, thank you so much. Let's stick with energy, since that really has been the hot spot, and dig into the unprecedented moves we saw in the week, both with respect to the price of crude as well as debt and equity related to it. Joining us now, James Spicer, head of high yield credit research at TD Securities. James, what a week. It's been quite a ride, huh?
It's been crazy. I think that people are still trying to figure out, what's going on. I think investors are shell-shocked, and people are trying to figure out how to price energy risk in this environment.
So how do you even go to analyzing the fundamental picture of, say, the shale patch, given the fact that we've seen a wild move in oil and you've got a price war between Saudi Arabia and Russia?
We've been here before. There's a precedent, 2015, 16. And so, companies have a playbook that they can open up, and they can adopt a lot of the same types of policies. We just saw Oxy cut its dividend. Companies are going to be cutting back capital spending across the board, trying to hunker down and retrench as much as possible in this environment.
There's a question of near-term financing, and there were a couple stories this week about energy firms, shale companies, that are going to the banks and saying, can you spare a dime? Can you lend us some money to get us through this? How willing do you think, or are you hearing the banks are, to actually extend new loans to some of these shale companies?
I do not think there is a lot of appetite amongst the banks to extend additional credit. Banks that already have credit outstanding to high yield energy companies especially are probably looking to reduce risk to the extent that they can. Now, they have their commitment levels outstanding to these companies, and they're not going to pull the rug out from underneath these companies, but there are borrowing-based redetermination seasons. The spring borrowing-based redetermination season is coming, and we expect to see some cuts from the banks.
If the banks do cut, and that season is coming up, what kind of insolvency rate are we looking at here?
Well, the banks are not likely to be the trigger to push a company into a deficiency or a workout or a bankruptcy. The banks don't want a whole portfolio of workout companies on their balance sheet. I think, banks are going to be prudent about trying to reduce risk, but they're going to do so in a way which leaves companies an ability to try to resolve the situation themselves. I think that more importantly, the near-term trigger for default is going to be refinancing.
Okay, we're looking at $120 billion, $20 billion less than it was yesterday, of high-yield energy debt in the United States. Can you give us a sense of what kind of defaults we're talking about here? How much of this debt could end up in default?
It's a question of time. I think in the near term, companies have hedges in place, companies have liquidity, companies have maturity runways for the most part. It's really a question of how long this low price situation lasts for. It's a question of how long the Saudis are willing to take the pain to produce 12.3 million barrels a day. At
$30 a barrel, traded on the NYMEX, what kind of bankruptcy rate are we going to see here?
I think over the near term, in 2020, really just a handful of companies, maybe 3 or 4 companies in the high yield sector, are at significant risk. I think if this lasts longer than, say, 3 to 6 months, then that universe grows significantly. Could it be, 30, 40%? Possibly.
Within the next year?
Within the next year, possibly.
If the prices stay where they are.
If the prices stay where they are.
And if not, perhaps a buying opportunity?
We hope so.
Well, James Spicer, thank you so much for being with me today. James Spicer, head of high yield credit research at TD Securities. Coming up, Oaktree Capital's Howard Marks weighs in on the buying opportunities in distressed debt. We've got more on that. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. The dean of distressed, Howard Marks, weighed in recently on finding bargains amid all the market volatility.
Certainly buying. I mean, if you're a distress investor, you must turn more aggressive when you're given good chances. I'm not saying this is the bottom, but this is certainly a time to do some buying.
So is it time to buy? Let's bring in our power player today. It's Victor Khosla, founder of SVP Global, which focuses on distressed debt and private equity investments with more than $8 billion in assets under management. Victor, do you agree? Is this time to buy?
Not quite yet. You know, we've just seen two shoes drop so far. We've had the coronavirus. We've had the oil price shock. And there may be a few more shoes to kind of drop. So yeah, look, there's been a sell-off. High yield spreads have gone out from 300 odd to 650 basis points to treasuries. But in the overall scheme of things, we think over the next month, the next 6 weeks, there's even a lot more downside to come.
What are you seeing in your actual existing investments? I mean, are you seeing in some of the companies that you work with some distress, or is there some independence from what we're seeing?
You know, the kind of sell-off we are just in the process of having, it is broad brush. Valuations are just coming down all across. So whatever you thought, if you thought something was worth 100 cents, something was worth $100 like 2 weeks ago, the equity markets are telling you it's worth $80 today.
All right. Well, it's not just Howard Marks, right?
Yeah.
And you are saying, that potentially could become a buying opportunity. And Stephen Schwartzman of Blackstone said, from an economic perspective, the virus has created dislocation in the market and fear among the people. It creates a substantial opportunity to buy assets and give credit to Howard Marks's point. And you were saying there will be a buying opportunity. How do you know when that's come?
Yeah, you know, none of us knows where the bottom is, Lisa, right? But can I give you a framework? Would it help?
Please. Yeah?
So let's say a private equity fund buys a company for $150 and they put $100 of debt on it. Now, the company now is worth $110, $120 instead of $150. As a distressed debt investor, we are looking for a big cushion. So this debt might have been trading at 90 cents, 95 cents before. Now, when it gets to 65 cents or 70 cents, we have that big cushion, right? We can take a lot more stress when you buy at 65, 70 cents. So I think when you think about distressed investing, our view, you have to think about it very differently than equity investing. In equity investing, you don't have the cushion. In our world, we are in a market now where we don't have to do an Excel spreadsheet and calculate exactly what our IRR is, right? When you get down to that 65, 70 cent level, you start buying, and if it becomes 50, 55, you buy more, right? So I think we think about it, distressed, very different than equities.
We're seeing certainly distress in the United States. We're seeing a sell-off here. Yeah. Over in Europe, there also is a similar market move, although perhaps buffered a bit by the ECB.
It's much bigger.
It's bigger.
Oh my gosh, it's bigger.
The opportunity or the sell-off?
Yeah, the sell-off too. Like in equity markets have sold off more than the US.
What about with respect to the opportunity?
Europe had $1 trillion in non-performing loans before all this coronavirus recession fear started. Europe had Germany, France, and Italy struggling, just trying to get through without going through a recession. So what's happened now? We think there's a recession in Europe now. You're going to see negative GDP prints coming out of all these countries, right? So the European opportunity, which was always big to start with, has just gotten much, much bigger than the United States.
So what kinds of investments are you targeting?
We like these old economy businesses. We like businesses with a lot of hard assets. And by the way, we like businesses in Northern Europe. We like them in Germany and the UK, not so much in Italy, not so much in Greece, right? So, and in that world, so look, Europe is much more a mid-market world. It's much more private debt. It's much more smaller deals, not kind of the name brand deals which get distressed in the US like American Airlines or like AMC Cinemas, right? It's just a whole different group of kind of deals. And that world, the $1 billion, $500 million, $1.5 billion deal, those are the ones we are targeting.
A lot of people look at the bond market and they say there's no yields because you're seeing yields go to zero in the developed world, but there's plenty of yield if you take the risk. What kind of returns could you expect with a strategy like yours?
You know, we are looking at, when you get this sort of a market move, this is already a once in 5 year crash, just what we are having, right? This is already equivalent in our view to 2015 with the oil and gas crash, or 2011 when the euro was going to break up, right? So in a market like this, we're looking for 20% plus IRRs in terms of the investments we're making. It's a market where capital is in short supply again. Capital married with skills. There's capital out there, but capital married with skills is in short supply, and so it is once again that moment in time.
A 20% IRR over what time period?
2, 3, 4 years.
2, 3, 4 years? That's fascinating.
Yeah.
Thank you so much. Victor Khosla, thank you so much for being with me. Victor Khosla is the founder of SVP Global. Coming up, private equity is a vastly different industry than it was 10 years ago, and we're going to talk to the recent dislocation. Does it have the wherewithal to prevail in the next economic downturn? A question a lot of people are asking right now. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. The last decade has been one of unprecedented growth for private equity. Assets managed more than doubled since the global financial crisis. But amid a picture of slowing global growth, the question is, how well can private equity perform in what could be the next economic downturn? Let's go now to Andres Sáenz. He is EY Global Private Equity Leader. He joins us from Boston. His firm just did a study about this very scenario, and I'd love to get your sense, Andres. Did you find that private equity firms in general were prepared for some sort of economic downturn or recession?
Absolutely, Lisa. I mean, they've been preparing for a while now. As you mentioned, the industry has been maturing, been growing, but they've also brought forth the lessons that they learned from the last financial crisis. I think everything they've bought in the last couple of years has been going through recession cases and scenarios so they can plan accordingly. They've been very deliberate about which sectors to invest in, things that look more resilient, they say technology, business services, et cetera. One of the big changes over the last few years has been the increase in operating resources, value creation teams. These firms have roughly 30% more resources on the ground than they did even just 5 years ago. Liquidity levels, they have leverage levels that are more resilient and covenants that are not too tight. And I think all in all, they recognized that in the last financial crisis, they were too passive on the investment side and that they missed opportunities to really bring capital into the equation.
All right, well, that brings us right to today. There certainly are companies where people are saying that there should be some sort of investment made, given the fact that we're seeing some dislocations and we've got companies saying that they might run out of cash if the slowdown due to the coronavirus persists. How many of these big private equity firms are stepping in and saying, we got your back?
Oh, I think they've been in some ways waiting for this moment to step in and provide capital. You know, when you look at even smaller companies out there, this is what they've been investing behind for a few years. They've isolated the sectors that they want to play in, and to some degree, they bring the capital in many different forms from an equity perspective, but also they've been raising these credit funds that can provide either short-term liquidity or just the ability to get deals done. But they really also provide the expertise and the know-how. Again, these value creation teams can be super helpful in these slowdowns and these periods of disruption, thinking through how do you chase growth, how do you operate more efficiently, How do you think you have sort of the right liquidity levels, et cetera? So they're in a great position to come in and really provide capital and expertise and know-how.
Andres, can you square this for me? Because I speak with economists all the time and investors who say that there are a lot of small and medium-sized businesses that are going to have a real issue over the next couple months if this coronavirus-induced slowdown persists. You've got the government saying we've got to extend loans, but you're saying there are all these companies that are flush with cash just waiting to lend to all of these small companies in a position of weakness right now and give them expertise. Is there no problem? Is there the gap and the money to fill the void?
Well, I think it's across the system. First of all, I think they will look at companies that are performing well, and in this environment, they're going to be able to make those investments at probably more reasonable valuations that they have in the past. And I think they are looking at companies that may be under more stress and saying, how can we come in and provide stability? And they've certainly raised the funds to be able to make those moves. I mean, I think right now they're at roughly $2.5 trillion in terms of dry powder. And again, if the lessons are true from the last recession, this is where they can make really, really good investments. The other thing that we've seen was from the last recession as well, companies that were private equity owned back then spent more on CapEx than companies that were not private equity owned. So we know there's a willingness to come in and really make a move. When you have these disruptive times, it is an opportunity to gain market share. It's an opportunity for interesting business combinations. And I think private equity has been thinking about this a lot. Now, I would say they've been thinking about the slowdown and preparing for it generically. If COVID-19 is indeed the trigger that pulls us into the slowdown, certain sectors are going to get disproportionately affected, both to the good and to the bad. And so there's some near-term reallocations that need to happen in terms of where the targets are and how private equity wants to play.
Just real quick, 20 seconds. Do you have a sense that there are a number of private equity firms that might get hit pretty hard by the slowdown?
I think no one is immune from this slowdown, but I do think the industry is much better prepared than they were 10 years ago.
Andres Sáenz, thank you so much for being with us today. EY Global private equity leader. We've certainly heard from Howard Marks of Oaktree, with Steve Schwartzman of Blackstone saying it's a buying opportunity, edified by what Andres said before. Now it is time for this week's big number. It is $239 billion. That represents how much the world's 500 richest people lost on Monday. That represents the biggest daily plunge since the Bloomberg Billionaires Index began tracking the number in October 2016. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time. This is Bloomberg.